Despite a long-running currency crisis and an economic slowdown, Zimbabwean banks are smiling all the way, well, to the bank. Income from transaction fees have been bolstered by earnings from discounting government-issued treasury bills. Financial institutions have upped their holdings of the government paper by 87% since the beginning of this year.
Between the lending, the ordinary lending, which is about 4.5 billion in this economy, and the discount of treasury bills, which are around 4 billion, there is a lot of interest income that was made there.
For foreign-owned banks, making profits has been the easy bit. The hard part is repatriating the dividends. Depleted Nostro accounts have held up foreign payments. The central bank says an investment portfolio fund which will expedite foreign currency payments for securities-related transactions is on the way. But banking sector analysts say it's a temporary setback.
This situation, when you take the long-term view, it will not remain like this forever. There will come a time when these problems will go away and they will be able to repatriate that capital. It would have been a tragedy if they were making losses here and they couldn't move back their capital. But the opposite is actually true.
But the stellar performances being reported now date back before banks were forced to cut their transaction fees, and a central bank cap on lending rates, which has seen them drop from as high as 30% in some cases to 15%.
Going forward, the money that the banks are going to be making from interest and those transaction charges is going to be lowered. But as of now, I mean, what's happening now is they are declaring profits on incomes that they generated maybe 8-9 months ago before these changes.
Banks will also have to find ways of sweating deposits that have increased as a result of the cash challenges and remained underutilized due to limited quality borrowers. Farai Mwakutuya, CGTN, Harare, Zimbabwe.